Passive income from REITs sounds simple. Buy real estate stocks, collect dividends, repeat. But in reality, this is where many investors make expensive mistakes. A REIT can pay monthly and still be risky. A REIT can pay quarterly and still be a better income investment. And the REIT with the highest dividend yield is not always the safest choice. So in this video, we are going to look at some of the best REITs to watch for passive income in 2026. Monthly payers, quarterly payers, net lease REITs, healthcare REITs, gaming real estate, industrial logistics, and diversified real estate income. But the goal is not just to create a list of tickers. The goal is to understand what actually supports the dividend. Because dividend frequency is convenient, but dividend quality is what matters. Before we talk about individual REITs, we need a simple framework. Because choosing REITs for passive income is not just about asking which one pays the most. That is usually the wrong starting point. A better income investor looks at AFFO or FFO, payout ratio, balance sheet strength, debt maturities, occupancy, tenant quality, lease duration, dividend history, and valuation. The dividend has to come from somewhere. If the cash flow is weak, the payout is stretched, or the debt load is too high, a big dividend can become a warning sign. That is why a high yield alone is not enough. The best REIT income comes from cash flow, not from chasing the biggest yield. Now that we have the framework, let's talk about a question many investors care about first: monthly dividends versus quarterly dividends. Monthly dividend REITs are popular for a reason. They feel more like regular income. They can be easier to match with monthly bills, and psychologically, getting paid every month feels good. But here is the important point. Monthly does not automatically mean safer. Quarterly REITs can have equal or even better business quality. They can have stronger balance sheets, better properties, better tenants, better growth, or a more attractive valuation. So investors should not ignore a great quarterly payer just because it does not pay every month, and they should not buy a weak monthly payer just because the payment schedule feels better. Frequency is not the same as safety. Monthly income feels better, but quarterly income can still be better. With that in mind, let's start with the most famous monthly dividend REIT, Realty Income. The first monthly REIT is Realty Income, ticker O. This is probably the most famous monthly dividend REIT in the market. Realty Income is a net lease REIT. That means it owns properties leased to tenants under long-term agreements, where tenants often handle many property-level expenses. The company is known for monthly dividend and a very income-focused brand. Realty Income declared its 673rd consecutive monthly dividend at 27.1 cents per share. That equals an annualized dividend of $3.25.2 per share. For income investors, that kind of consistency is attractive. But consistency does not mean the stock is automatically cheap. Investors still need to watch valuation, interest rates, debt, tenant quality, and growth. Realty Income is the classic monthly dividend REIT, but classic does not mean automatically cheap. Now let's look at another monthly net lease REIT that is often compared with it, Agree Realty. The second monthly REIT is Agree Realty, ticker ADC. Agree Realty is also a net lease REIT, but it has a more focused profile than Realty Income. It is heavily tied to retail real estate, especially properties leased to high-quality tenants. ADC declared a monthly dividend of 26.7 cents per share. That equals an annualized dividend of $3.20.4 per share. For investors who want monthly income, ADC can be interesting because it combines a monthly payout with a more focused net lease strategy. But the risks still matter. Retail exposure matters, valuation matters, and cost of capital matters. Like other REITs, Agree Realty has to buy properties, finance growth, and maintain attractive spreads. So ADC may appeal to investors who want monthly income with a more focused net lease profile. But if you want a higher yield monthly payer, the next name has a very different risk profile: EPR Properties. The third monthly REIT is EPR Properties, ticker EPR. EPR is not a typical net lease retail REIT. It is an experiential REIT. That means its properties are tied to entertainment, leisure,
experiences, and discretionary spending. This can include cinemas, recreation, entertainment venues, and other experience-based real estate. EPR declared a monthly dividend of 31 cents per share. That equals an annualized dividend of $3.72 per share. The income can look attractive, but this is not the same kind of risk as a highly diversified essential retail portfolio. EPR has more exposure to cyclical behavior. Consumer spending matters. Cinema exposure matters. Economic sensitivity matters. And because the business model is more specialized, investors need to be more careful. EPR can offer higher income, but higher income comes with higher business risk. Now let's move from experiential real estate to healthcare real estate with another monthly payer, LTC Properties.
The fourth monthly REIT is LTC Properties, ticker LTC. LTC is a healthcare REIT focused on senior housing and skilled nursing properties. This gives the company exposure to a powerful long-term theme, an aging population. Healthcare real estate can be attractive because demand may be supported by demographics, but it also has its own operating risks. LTC declared a monthly dividend of 19 cents per share. The monthly payout is convenient, but healthcare real estate is not automatically safe. Operators can face pressure. Reimbursement rates can matter. Tenant stress can affect rent collection, and the healthcare sector can be complex. So, LTC is a monthly payer, but healthcare real estate has its own operating risks. Now that we have looked at monthly payers, let's shift to quarterly REITs because some of the best income REITs do not pay every month. The first quarterly REIT is NNN REIT, ticker NNN. NNN is a net lease REIT focused mainly on single-tenant retail properties. It is not the flashiest REIT, and that is part of the appeal. Income investors often like businesses that are simple, consistent, and disciplined. In the first quarter of 2026, NNN reported AFFO per share of 87 cents. Occupancy was 98.6%, and the quarterly dividend was 60 cents per share. Those numbers matter because the dividend needs cash flow support. A quarterly payout can still be very attractive when the underlying business is consistent. The risks are still there. Retail exposure matters, growth may be slower, and interest rates still affect REIT valuations. But NNN is not flashy, and that is exactly why income investors watch it. Next, let's look at a quarterly pair with a very different property type, VICI Properties. The second quarterly REIT is VCI Properties, ticker VICI. VCI is not a traditional retail REIT. It owns gaming and experiential real estate, including major casino and entertainment properties. The company declared a quarterly dividend of 45 cents per share. The appeal of VCI comes from long leases, large operators, differentiated assets, and exposure to experiential real estate. This can make VCI interesting for income investors who want something different from standard net lease retail. But the risks are also different. There is sector concentration, there is dependence on gaming operators, and valuation still matters. A unique property type can be attractive, but it can also create specialized risk. VCI is not a traditional retail REIT. It is an income play on experiential real estate. Now let's move to a diversified net lease REIT that offers attractive income, but also has an important dividend history investors should remember, WP Carey. The third quarterly REIT is WP Carey, ticker WPC. WP Carey is a diversified net lease REIT. Its portfolio includes industrial, warehouse, retail, and operationally critical real estate. This makes WPC broader than many REITs focused on one property type. The company raised its quarterly dividend to 93 cents per share. That equals $3.72 per share annualized. The income is attractive, and the diversification can be appealing, but investors should remember the dividend reset. For income investors, dividend trust matters. Even if the business looks better now, the history still deserves attention. WPC also carries risks around tenant credit, debt, interest rates, and valuation. So WP Carey may offer attractive income,
but investors should remember the dividend reset. Now let's look at a REIT that may not have the highest yield, but often stands out for quality. Prologis. The fourth quarterly REIT is Prologis, ticker PLD. Prologis is an industrial and logistics REIT. It owns modern warehouse and logistics real estate tied to supply chains, distribution, and e-commerce. The company declared a quarterly dividend of $1.07 per share. Now, PLD may not have the highest yield compared with some high-yield REITs, but that is exactly the lesson. The highest yield is not always the best REIT. Quality matters, scale matters, location matters, tenant demand matters, and long-term growth potential matters. Prologis can appeal to investors who want income but also want exposure to high-quality logistics real estate. The risks are valuation, the industrial cycle, development risk, and the possibility that investors overpay for quality. PLD may not have the highest yield, but quality can matter more than payout size. And before we turn this list into a practical framework, this is a good point for a quick pause. This is the kind of REIT income analysis we focus on at Boring Money Wins, not just asking which REIT has the highest yield, not buying something only because it pays monthly, not ignoring AFFO, FFO, payout ratios, debt, tenant quality, and valuation. The goal is to understand what supports the income. If this kind of no-hype REIT breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want passive income analysis without the noise. Now that we have looked at monthly and quarterly payers, let's talk about how to actually build a REIT income portfolio, because a good income portfolio should not depend on one ticker alone. A passive income REIT portfolio should not depend on one REIT, one tenant, or one sector. That is the key idea. An investor might combine net lease REITs, industrial REITs, healthcare REITs, experiential REITs, gaming real estate, and possibly other sectors like data centers or self-storage. But the goal is not to collect tickers randomly. The goal is to assign roles. Some REITs may be core income holdings. Some may be higher yield, higher risk positions. Some may be lower yield, higher quality growth REITs. A strong income portfolio usually needs diversification and discipline. If one REIT cuts its dividend, the entire income plan should not collapse. If one sector struggles, the whole portfolio should not break. And if interest rates move, investors should understand how their REITs may react. A passive income portfolio should not depend on one REIT, one tenant, or one sector. And that leads directly to the biggest mistakes dividend REIT investors make. The first big mistake is chasing the highest yield. A high yield can be attractive, but it can also signal risk. The second mistake is confusing monthly payments with safety. Monthly is convenient, it is not a guarantee. The third mistake is ignoring AFFO and FFO. For REITs, cash flow metrics matter because the dividend needs support. The fourth mistake is ignoring debt and interest rates. REITs are capital-intensive businesses, and funding costs can change the math. The fifth mistake is ignoring valuation. Even a great REIT can become a poor investment if the price is too high. The easiest way to lose passive income is to buy income without checking the cash flow. So before buying any REIT for income, investors should ask a simple question. Is this dividend supported by durable cash flow? Now, let's bring everything together into the final verdict. So, what are the best REITs for passive income in 2026? The answer depends on what kind of income investor you are. Monthly payers like Realty Income, Agree Realty, EPR properties, and LTC properties can be attractive because the cash flow is frequent, but they are not all the same quality or risk level. Quarterly payers like NNN, VICI, WP Carey, and Prologis show that quarterly dividends can still be very relevant for passive income. Some offer consistency, some offer higher income, some offer growth and quality, some come with more risk. The key is not the payment schedule. The key is the durability of the cash flow. Monthly income is convenient. Quarterly income can still be excellent. And the highest yield is not always the best choice. The best REIT for passive income is not the one that pays the most often. It is the one that can keep paying through cycles. Passive income should be boring enough to survive, and boring money usually wins because boring money usually survives.